Welcome to the Deep Dive. Today, we're cutting through the noise, giving you the essential context on a really key player in rural America.
Yep.
Our focus. Tractor Supply Company. They just had their Q3 2025 earnings.
It was really heavily skewed towards transaction growth. That was up 2.7%. The average ticket, well, that only grew about 1.2%.
So that signals healthy foot traffic, people actually coming in the door. It's not just prices going up or people buying, more expensive things.
Exactly. Consistent traffic.
So record revenue, EPS beat, robust traffic. But here's where it gets, really interesting, as you said. The market sold off.
Yeah.
Shares traded lower. It just signals this clear kind of structural anxiety that seemed to overshadow the clean performance. What gives there?
Well, I think it shows investors immediately look past Q3. Their focus snapped right to the future.
Okay.
Specifically, the tighter guidance range for the full fiscal year 2025. It just broader concerns about, softness and the macro retail picture. Basically, yeah, management won the sprint. Q3 looked good, but investors sold off because they're worried the marathon ahead is getting tougher.
So those forward-looking fears just completely canceled out the Q3 positives?
Pretty much overshadowed them, yeah.
Okay, let's dig into that 3.9% comp growth then. What were the specific levers? They always anchor on those consumable, usable, edible categories, the CUE stuff.
Absolutely. CUE is always the foundation. Livestock feed, pet supplies, seasonal necessities. That's the defensible, repeatable revenue.
Right.
But they also got a pretty significant timing boost this quarter, something management actually called the bathtub effect.
The bathtub effect. Okay, tell us more about that. Sounds intriguing.
Yeah, think of it like this. The summer season was extended. It was warmer for longer. And that pulled some sales forward into Q3.
Okay.
Sales that maybe historically would have landed more in the first half of the year. Management put a number on it, estimated it gave Q3 about a 50 to 60 basis point bump.
So 0.5% boost just from the weather timing?
Roughly, yeah. Which helped fuel strong performance in some bigger ticket items too, like tractors, riders, those zero-turn mowers especially, and lawn and garden.
But that strength, it had to overcome some serious headwinds too, right? It wasn't all smooth sailing.
Oh, definitely not. Significant headwinds. They pointed specifically to weakness in discretionary categories and also weather-dependent ones.
So what kind of things are we talking about there?
Things like recreational vehicles, grilling supplies, generators, even safes, stuff that often signals, a less cautious consumer, maybe making those bigger non-essential purchases.
And why the weakness there? Just general consumer caution?
That was part of it, yeah. People delaying those big discretionary buys. But also they had a tough comparison because last year they had storm activity driving sales. This year, nothing.
Right. No emergency storm-related buying for generators and supplies like last year.
Exactly. That was a direct contrast and a headwind.
Okay, but back to that transaction growth, that 2.7% increase, that really suggests customer engagement is exceptionally high. How sticky is this customer base, especially if consumers are getting more cautious overall?
It seems incredibly sticky. I mean, look at the Neighbors Club, their loyalty program. It now accounts for over 80% of total sales.
Wow, 80%.
Yeah, that's a massive captive audience. And they didn't just maintain loyalty. They hit record Q3 highs across every major customer metric.
Like what?
Total customer count, new memberships, reactivated customers, retention rates, all record highs for Q3. And they've had durability in these metrics for 17 straight quarters.
17 quarters?
Yeah, that's a really powerful insulator against some of the short-term macro noise you might see elsewhere.
Oh, wait a second. If customer loyalty is that high and transactions are growing, why is management still spending so aggressively on these new initiatives like direct sales, final mile delivery? Shouldn't they be, harvesting margins more?
Well, they'd argue those investments are critical. It's about capturing the next level of customer, maybe that big barn professional customer, and just locking in relevance for the long haul.
Okay.
Take the direct sales initiative. It's scaling fast, targeting those higher value pros. They've got, 48 specialists covering over 300 stores now?
And the ticket size.
The average ticket there is currently about 7 times the company average. 7 times. Yeah, it's generating over $200,000 in weekly sales already. So that's serious potential revenue per customer.
And they're still investing heavily in the physical stores too, right? Project Fusion layouts, garden centers.
Right. 55% of the chain is now in that Project Fusion layout, which is really about modernizing the experience. And nearly 700 garden centers now. They're clearly betting that their physical footprint is a long-term strategic advantage, not a liability.
And you can't overlook the digital side either, especially that retail media platform.
Definitely not. Often overlooked, but it's generating real traction. It's on track, they said, for triple-digit revenue growth year over year.
Triple digits.
Yeah. And that's pure high-margin revenue. It just drops straight to the bottom line. A really powerful lever for the future.
Okay, let's pivot to the P&L structure itself, because the margin dynamics here, I think, are the crucial link to this whole 2026 story. Gross margin actually expanded a bit, right? 15 basis points.
They did, up to 37.4%, which is pretty impressive in this kind of inflationary environment.
How'd they manage that?
It reflects disciplined product cost management and what they called surgical pricing. So they're managing costs well and being smart about where they take price. And that's successfully offsetting pressures from like ongoing tariffs. They say they're about halfway through the incremental impact there, and also slightly higher transportation costs.
Okay, but the flip side was selling, general, and administrative expenses. SG&A, that was the drag. Up 8.4%, deleveraged by 29 basis points. Can you translate that deleverage part for listeners maybe not glued to financial statements daily?
Sure. So when a cost line like SG&A deleverages, it just means the growth in those operating costs slightly outpaced their net sales growth for the period.
Got it.
So SG&A grew 8.4%, while sales grew 7.2%. But this was expected, planned even.
Wow.
It was primarily due to those planned strategic investments we just talked about. Things like building out the direct sales team, the final mile delivery infrastructure.
Great spending initiatives.
Exactly. And also higher incentive compensation for the store teams, partly because they executed well in Q3.
Okay, so management says this investment spending is purposeful, it's critical for the long term, but 8.4% growth in SG&A still feels aggressive. What's the real risk here that these bets, especially something complex like final mile delivery, don't quite pay off and just become, permanent structural cost inflation?
Yeah, that really is the $64,000 question, isn't it? Management sounds confident these initiatives will mature, they'll become self-funding, allowing them to ease back on that heavy investment spend, maybe as soon as 2026.
But the risk is?
The risk is they misjudged the complexity or the capital needed, and that cost structure has basically shifted higher permanently. If that happens, they'll need significantly higher comp growth than they've historically needed just to get margins expanding again.
Which makes that 2026 narrative absolutely critical. It's essentially a promise that this spending bump is temporary.
Precisely.
Okay, this brings us right to the moment the market reacted most negatively, the guidance. Management narrowed the range for fiscal year 25 net sales growth, and comps too, only plus 1.4% to plus 2.4%. That definitely signaled caution.
It did, and especially the Q4 forecast. They gave an extremely wide comp sales growth range for Q4, 1% to 5%.
1 to 5%, that's a huge range.
Huge. And they were very clear about why. They said that massive volatility is entirely dependent on winter weather.
Right.
Unlike traditional retail, where, the holidays drive Q4 for Tractor Supply, Q4 is fundamentally driven by when winter hits, how severe it is. Think snowblowers, cold weather gear, feed demand, emergency supply.
So it all comes down to the weather forecast, basically.
Which is inherently unpredictable. And that reliance on such a big variable, well, it clearly spooked investors.
Okay, but if we connect this Q4 volatility to the bigger picture, the discussion around 2026 starts to look like maybe the central opportunity here. The thing the market might be ignoring right now.
Absolutely. I think that's spot on. The commentary for 2026, while preliminary, it signals a potential return to a much more, let's say, normalized year. Well, for one, they're showing confidence just by planning to open 100 new stores next year. That's up from 90 in FY25. You generally don't accelerate store openings if you're deeply worried about the underlying unit economics breaking down.
Good point. And the margin story, that changes completely too, right? It shifts from this cost growth narrative to leverage.
That is the crucial inflection point they're pointing to. They anticipate those SG&A pressures normalizing as the big strategic initiatives like direct sales and final mile start to mature and self-fund.
Right.
And management actually put a marker down. They explicitly said they see an operating margin inflection point happening around the low 2% comp sales range.
Okay, what does that mean practically?
It means if they hit even a modest comp, say 2.5% in 2026, their operating margins are expected to actually expand proportionally above that level. That normalization of costs, combined with that sticky customer base and continued transaction growth. Well, it provides a potentially clear structural tailwind looking ahead.
Which really raises the critical question for investors, for you. Will the market look past this short-term Q4 weather messiness and actually start pricing in this potential 2026 P&L normalization, that whole margin expansion story?
Yeah.
Because that's often where opportunity hides, right? In that transition from near-term uncertainty to longer-term clarity.
Exactly.
All right, this brings us to our not financial advice segment. We're putting on our, let's say, high-stakes pitch hats for a moment, proposing an outrageous but plausible trade thesis based on everything we've just unpacked.
Okay, let's do it. My high conviction, definitely non-consensus trade idea is this. Long TSCO through the Q4 volatility, precisely because of the 2026 margin inflection story.
Okay, so the market's obsessing over the tight FY25 guide, the weather gamble in Q4. Why buy into that weakness now?
Look, the market sees Q4 as basically a coin flip, right? Could be 1% comps, could be 5%, who knows? It's all weather. But the 2026 narrative, that's structurally much better. SG&A pressures are expected to ease, driving margin expansion even at a, frankly, modest normalized comp rate like low twos.
So the entry point strategy is?
The pitch is you buy into any weakness driven by maybe an unseasonably warm November, early December. You basically treat the stock like an underpriced call option.
Okay.
An option on that 2026 margin expansion narrative. If a cold snap hits late in the quarter, great, you win on Q4 too. If it doesn't, well, you've just lowered your entry price for the more important 2026 story.
Okay. Now, what's the outrageous detail? The secret catalyst, the kicker that reinforces this entry point and maybe proves brand relevance is even stronger than people assume?
All right, here it is. The market is completely failing to factor in the retail theater and, frankly, the social media buzz generated by a now famous 6-foot holiday rooster.
The giant rooster.
Seriously, this unique, kind of fun, highly shareable piece of merchandise. It's doing more than just selling. It's reinforcing brand relevance. It's driving unexpected traffic among that core rural consumer base right during the critical winter readiness shopping period. That rooster, it kind of validates that management is still finding these quirky, effective ways to generate excitement and foot traffic. And that, I argue, positions the company better to maybe hit the higher end of that wide Q4 range.
Which would then
accelerate the market's acceptance and adoption of that much more robust 2026 narrative we've been talking about. It's the rooster catalyst.
The rooster catalyst. Okay, I like it. Outrageous, but plausible indeed. Well, that brings us towards the end of our deep dive today. And the core tension, I think, remains perfectly clear. On one side, you have really strong Q3 operational execution, a sticky customer base, and what seems like a clear structural path to margin recovery in 2026.
Right.
But that's tempered significantly by this near-term tightness in the FY25 guidance and just a generally nervous macro sentiment hanging over retail.
Yeah, that sums it up well. And maybe my final provocative thought for you, the listener, to mull over is this. We know discretionary retail is facing real headwinds, right? So how truly defensible are even Tractor Supply's core CUE and pet livestock categories against potentially broader consumer caution spreading? And maybe more importantly, how quickly will that impressive transaction growth actually convert into meaningful operating margin leverage once those big strategic investment costs start to normalize in the year ahead? Is that 2026 inflection a sure thing?
Excellent food for thought there. How resilient is the core and how fast does the leverage really kick in? Great questions. Yeah. Thank you for joining us for this in-depth analysis. As always, we absolutely encourage you to do your own independent research and analysis before making any decisions.
Definitely.
We'll catch you on the next deep dive.